Morning everyone and welcome to the room. As you all know, trading futures involves risk. It's not suitable for all investors. Information in the presentations for educational purposes, not a trade signal service, not intended to be financial advice. Hope everyone's doing well this morning. Hope you had a good weekend. Pretty good day in the markets yesterday. Sizable move down. And not just that, but pretty good movement throughout the day. Sometimes we get situations where we get these gap ups or gap downs, and then the market just kind of craps out and doesn't go anywhere. Well, yesterday we had a pretty good move off the open, which we can talk about, and a couple of other bounces that didn't end up taking us out of lows for the day until kind of the end of the day, but some substantial bounces that were good for 4, 5, 6 points. And when it comes to day trading, especially the ES or the NASDAQ or the YM, any of these kind of main indices, I'm not so much concerned with picking the top or the bottom as I am with simply identifying where is the momentum changing. And the better we can identify the trend, the better we can identify where that trend might be coming to an end, might be changing direction. And even if it's only for a short pullback, sometimes you get a handful of swings like that, 4 or 5 points here, 4 or 5 points there, and ends up being a pretty sizable day. As far as the overnight's concerned, not seeing a ton of activity that is very meaningful. That's not surprising with a big down day yesterday. A lot of traders are kind of shaken out of their positions, and it was significant that we stopped right at 2,700. It's also significant that we closed the day right at the 61.8. So today, if we can break this 27.21 again and close below it, then I would call that a confirmation of not just a break below, but a close below. Anytime you move above or below a support level or a resistance level, and then you come back into it and you close back in that range, that's a sign that the bulls or the bears are able to kind of retaliate against the move. So like yesterday, a lot of this move down was stops being taken out, was people starting to panic as the market started to accelerate down. But then as we closed, buyers coming back in to push the market back up into what I would consider still a positive area above the 61.8. That shows that there's interested buyers. Now, one thing that is puts kind of a little bit more weight to the downside here as we get the bell. So if we look at this swing low back here on 529, and then we come over to the VIX. The VIX is a measure of volatility, and we notice that yesterday's swing low pierced the high from 529. Now the VIX is going to be inverse of the S&P, and so a spike in the VIX typically coincides with a down move in the S&P or the broader market. Well, as we look at the relationship between these swing highs, notice that yesterday's high broke the high from 529. And so a lot of times the volatility index leads the S&P when we get a spike like that. So yes, we didn't close above it. That would be more significant, but breaking highs is still significant. You can think of it a little bit like if we made a new high in the overnight. Is it significant? Yeah, but I would want to see it trade there. I would want to see the markets go there during trading hours where there's more volume. I want to see that backed up and see that follow through. So you can think of the VIX a little bit the same way. Yeah, we pierced that swing low or that swing high. Notice the 529 low is still way back here. We have not pierced it. The Dow did. So here's the S&P. The Dow did break its 529 low. The NASDAQ, not so much. Actually, wait a minute. Where am I at here? NASDAQ. Yeah, NASDAQ not so much. And then the Russell, kind of the strongest one of the bunch. Increasing volume on the move down. So it's definitely there's definitely more here in this pullback than say back here at the end of May. Look at the volume on that pullback was very low. And then as we started to move higher again, what happened? The volume increased. Well, on this pullback, we see increased volume as the market's moving down. And so whenever I'm looking at the markets in general, I'm always relating the market I'm trading or the market I'm looking at to other things. So I'm looking at the S&P here and I'm saying, okay, well, what is stronger, the S&P or the Dow? Well, clearly the S&P is looking stronger at this point. And then I can zoom in a little more and I can say, okay, this pullback, how does this relate to the prior pullback? How does this day right now compare to yesterday? Well, we are inside yesterday. We are inside yesterday's range. You can see that a little bit clearer on the ES chart here. Kind of opening right in the middle of that range. And so by relating, even individual stocks, we'll take the S&P as a starting point or the NASDAQ, and then we'll go over to Apple and say, okay, well, how does the Apple chart compare to the NASDAQ chart as a whole? Well, it kind of was a little flatter up here, but then the pullback was a little deeper. And so as you begin to look at the relative strength and weakness and just relativeness as a whole, it can be a really helpful way to get some perspective and to kind of get a read on how the market you're trading or the day you're trading or the stock you're trading might react when some of these outside forces end up pushing or pulling on the market. So not a big gap today. We'll talk about yesterday's gap and how I traded that. But the first thing I'm noticing is inside day, which pretty easy to do when you close in the middle of a big range. And if you think about the balance, I pull up the market profile chart from yesterday. 2716 is where the point of control is. You can see a very big, long profile, 2706 all the way to 2724 is the value area. So that's a pretty big range, and we're kind of right in the middle of that right now. And you can see as these columns get thicker, that means more trade, more time has been spent at that price. And so the market being at 2721 right up here, it's a fairly time has been spent here yesterday, but the chance that we move down to 27.16, fairly quickly, I would say in the first 30 minutes is pretty high. We could also move up and see some resistance at 27.24s. So that's kind of how I use, the relative price and trading from the prior day as it relates here to market profile. So the good thing is, with a bigger range, even though we're inside, we could have a bigger range today. We're already about 7 points on the day here. So just because it's an inside day doesn't mean it's a no trade day. However, the further you get away from the prior day's close, especially like yesterday when we gapped down, the further away you are from this equilibrium point that you can define or that you can identify on the market profile. And when you get away from that equilibrium, especially in a gap form, you get a lot more traders that are sort of caught off guard or in positions that are now underwater, in positions that are now very profitable. And so then a lot of things start to happen with stops getting taken out, profit being taken, new positions being put on because prices might appear more desirable down at these levels. But when you open up right at the close of the prior day, a lot of times, there's not a big hurry to do a lot because the sentiment is pretty much where it left off. As I look to the breadth here and the advanced decline line, I'm seeing 1-to-1 and right around 200 and change. So pretty balanced thus far. And that makes sense because we opened at the prior day's close. But I expect we'll see a little bit of movement here today just because the range from yesterday is so big. And when you get a really big range, even though the VIX isn't very high itself, it should yield a little bit more volatility. So not super interested in anything that happened here in the overnight, so I'm just turn that off. So in the last couple of weeks, you can kind of, if you can recall, in our discussions about the first 30-minute range and how on days, for example, here on Friday, that these are 30-minute bars now on the chart, when we open up and we trade 30 minutes into the day, and then we stay within that range, well, first of all, if that range in itself is small, so like Friday's range was 8 points, it's not a terribly small range, but in order to get 4 or 5 points out of that range, you have to have the market be moving in one direction and then change direction. You need a little bit of room on the front end, a little bit of room on the back end. So, to take out 5 points in an 8-point range, that's you're capitalizing on most of the move. Now, when you have an open first 30-minute range and then we move outside of it right away and then we don't come back into it, the likelihood that there's going to be a lot more movement is much greater. So you can see yesterday, first 30-minute range was pretty big. Then we traded lower. We came back up and traded at the bottom of the first 30-minute range, and immediately there was selling, as presented by this inverted hammer candle. And we never really made it back up to the first 30-minute range. So two very different days, and just easily identified by the first 30-minute range. Now, I want to talk about the gap of yesterday, but before I do that, just by starting the morning highs, taking it to the very next low, we can see that the market is adhering to its first 50% retracement, broke the swing low, came up, traded at the 50. So I like to give the market 15 minutes to settle out, but I still like to kind of follow along. So at this point, I'll draw from highs to lows and just kind of watch and see, does the market stop at the very first full halfway back for the morning? Doesn't look like it. We've got a low down here, and if we take that to the very first high, we can see, okay, there is good adhering to the 50%. There's participation. It's being bought. So just this is just a way to kind of get a read on how the market might be trading today. 637 is the low tick, and we're very close to a low tick at lows. About us, just 1 minute off. Made it down to an 18 and a quarter. Not really anything happening from yesterday's kind of the last swing low to highs. We traded in a little bit. I guess you could say there was a little bit of a pause, but not really any continuation from retracements happening yesterday to today. And that's fairly common with bigger days. We could kind of draw from lows to the double top, but I don't like to get too crafty with my drawings. Just try to keep it as simple as possible. If I'm not seeing anything there, I'm not going to try and find something. If you kind of have 2 points. So, and this is pretty common. So this will be helpful, I think. Let's say you've got this move down, the very last drawing that you can make from a high to low. When that fails, I'll immediately go to the full halfway back to where I started at highs down to lows. I won't start drawing up from the next higher high and then, if that one fails, go to the next higher high, because you just end up trying to short a market that's just kind of ripping through and is not showing any signs of stopping. And the same thing is true for long. So if the final short fails, draw all the way halfway back. And just like in the longs, we're drawing longs. Okay, this one had a nice run, and then let's say you draw another long up here and it fails, then I would just go right to drawing from lows all the way to highs. I wouldn't try and grab anchor points halfway or in the middle or 2/3 of the way down. Now there's some times where the market does stop and you're kind of looking and saying, well, it's not really a drawing that I had up, but sometimes you can go in later and look back or figure out, okay, well, maybe this is a support level that is being bought. But you don't know that at the time. So to keep things as simple as possible, I just revert to the full halfway back so that I'm not trying to catch a falling knife, putting an order at 24s and then 22s and then 21s. I would rather see a move trade like this and then trade the next one in the series, and then trade the third one or the fourth one, so on. News-wise, consumer confidence here at the top of the hour. And that's really all that's on the calendar for today. Later in the week, GDP, consumer sentiment on Friday, international trade goods tomorrow. But really, I think the bigger impact on the market is going to be the market with the trade conflicts and discussions thereabouts. So in this situation, drawing the full long and then drawing the short, seeing whichever one trades first. So we've got a 25, we'll call it a 25.50 short. It's not really a double top, but it's close. And in trading, close is close enough. Now we're also, on a day where we're in a tight range so far, we'll call it a tight range, but 1-to-1, as we get closer to the midpoint here, we're in less opportunity territory. So trying to short highs and buy lows is a good strategy when you're range bound, but if you get into the middle of the range, then the risk sort of starts to disappear. So 25.25, I'll see if there's anything there, and if not, if we start ripping up, then I'll, in about 10 minutes, I'll draw the high and the low of this first 30-minute bar, and if we stay outside of it, let's say we move up from here, then we may end up in a kind of a ripping day here, one way or another. But you can use that first 30-minute bar as your kind of initial signal. Let's take a look at the NQ. So NQ made a higher high already. And then the YM did not. So again, coming back to that relative strength and weakness, kind of looking at the markets as how they relate to one another. So 25.50s is getting a solid reaction, but coming down to the halfway back long. Always using the negative 23% target as a first target. It's just a really good habit to get into. It forces us to, if you think in baseball terms, taking that, hitting that single, getting on base, and the idea is to get to 2 or 3 contracts so that we can, at least in getting to 2, then you have one to trail. So just like putting my order a tick or 2 in front of the 50, I put my target a tick or 2 in front of the negative 23. If you have one contract, you're kind of constrained to taking that profit or trailing. You have one opportunity. You can either trail or you can take the profit, but you have to do the same thing every single trade. Otherwise, you end up just back and forth, back and forth. Now we have another lower tick at the 50% halfway back of the day. I won't be surprised here if we can come up and break highs, just because the bias from yesterday was so down. I like to think about the opposite. So it wouldn't surprise me when something like that happens. So it's just good to think about multiple sides of the equation. Keeping your stop above the entry high, the swing high is very helpful, and especially in situations like this where the market just comes up and makes a double top. And the more you can relax and separate yourself from the actual dollars that you're trading, trying to become a little bit freer, I guess, with your trading account in some sense, can really help, prevent yourself from getting overly excited and tightening your stop too quickly. So now that we've broken the long, I'm just going to delete that drawing. Notice again, right smack dab in the middle of the range, even on the way up, there was nothing there. There wasn't really any participation, and the middle of a range is not a strong opportunity place to take trades. So you always want to be careful there. So we're down through the negative 23. And you get a couple options. You can leave your stop above the swing high. That would be the conservative approach. You can put your stop, something I've been doing lately. I used to do it and then I kind of stopped, but I've been doing it more lately, putting my stop above the next 61.8 and just, rounding up and adding a tick. So 27, 24 and a quarters. Because let's say you weren't in a trade right now and you were looking at getting in this trade short at 23s. You got to ask yourself, okay, where would I be wrong on this trade? Where would I want to get out? And where would I know, what would signal to me that the trade is over? The trade is not working out. Well, it'd be the 61.8. So if that's where you're wrong, that's your line in the sand, then placing your stop there is a really good way to do that. Now, when you get another swing high, which would be defined by a break in lows, you can tighten your stop down a little bit more. In some cases, when we get a little double bottom like this, I will also tighten my stop. But in this case, what are we? A point difference, so I'm not really too concerned about getting taken out at 24 and a quarter versus 23. It's a pretty small double bottom, but either way, using the 61.8 or using swing highs is a great way to manage trade. And once you're taken out like that, just move on. So we just as I said earlier, we had this the most recent short, and then when that breaks, just revert to all the way halfway back. So that high that I started with down to lows, and sometimes there's only, like this case, there's only 2 shorts in the move, and you end up getting taken out, and then you're not too far from the next 50. There's not really a whole lot you can do about that other than keeping your stop a little bit more conservative. But I'm totally fine with getting taken out of a trade at a swing high break at a 61.8. That it doesn't bother me if the market then continues on. Because you can only manage the trade. You can only manage what you see. You don't know if the market's going to take you out of a trade and then decide that it's going to continue back in your direction. So if you start dwelling on that stuff and kicking yourself, then you miss the next opportunity. Just manage the trade you're in, ride it out as long as possible, and then when you get taken out, boom, move on to the next one. It's a nice little double bottom. I like this pattern. Now the context here, we have a double bottom, then we shoot up, we break this swing high. Now in this case, we traded at the short first. So I would not say that the long here is valid. It is not in play because the short is already in play. Short traded first. But this pattern, a double bottom, you come up, you break the swing high, and then pull back, is one that I like. A little bit of a triangle forming. We have a high and a low, and then a lower high, higher low. We should break out of this pretty quickly, but here again at that same low, called a triple bottom now. Now if we were to come up, break this prior swing high, and break through the 61.8, I might consider taking a long, sort of in anticipation of a breakout, but we'd have to break the 61.8, breaking this swing high at 25.50s. And you notice the most recent 30-minute periods from yesterday kind of moving up. And so if we were to continue that trend this morning, there may be an opportunity to get in ahead of a little bit of a move higher. But the market would need to go a little bit higher first before I'd entertain that idea. I'm going to start marking up my profile here. So market opened just above yesterday's value area, traded down, not quite to that 27.16s, but close. And kind of now hovering right around this 24s, top of value. So if we were to break out above 24s, we might have an opportunity where we pull back to it, and then that gives us some lift. So, you have a resistance area above us, a ceiling, and we're kind of punching at it, and then boom, if we can break through it, let's say you pop up, what would be a good visual? I suppose you're underneath the ice, and you break through it, and you pop up through the ice, on a frozen lake, and then once you climb out, if you move 10 feet to the right, you can stand on the ice next to you, and now it acts as support. guess the same thing can be said if you punch a hole in your ceiling and you climb through it and you move 4 feet to the right. You're standing on solid ground and there's a hole a couple feet to the left of you. You could still fall back in that hole. You could still fall down through the resistance that you just pushed through, but there's a better chance that you'll have support there. Okay, so now we have this triple bottom here. I'm going to draw up this next long. Now, again, the triangle is much more clear now. We've got the high and the low, got a lower high, higher low, and so now we're very anticipatory trade. We haven't gotten the breakout, but we're sort of anticipating the breakout. And we may get there before we get a pullback. You don't know. I'll draw up the high and low, and we'll see what we get. Let's see if you went into the day with so it's a 2450 would be sort of that anticipatory, breakout, taking a stab at the near the apex, just based on the trend that has been happening over the last couple of hours from yesterday's close. In a high tick up here. And Q did hold its halfway back of the morning. And looks like it's on its way to be breaking out. And if we don't get a pullback in the ES, there will be more opportunities. YM, not so much. Sort of a triple top. Makes this a little bit riskier down here. $24.75. You can also wait for the breakout and let the market pull back to 28s. Take a stab there, but 24.75 is valid. Just have to realize that it's sort of anticipatory. We're still within the first 30-minute range, so we haven't gotten that breakout yet. And the breadth is still 1-to-1 and pretty much where it was at the open. Not a lot has changed. So the risk is just slightly higher. If you caught last night's video, I was talking about the gap from yesterday morning. And whenever we have a gap that's outside of the previous day's range, that leads an opportunity for us to either fill the gap or continue in the direction of the gap. And yet in yesterday's case, we continued in the direction of the gap. And what I like to do is simply bracket the first 5-minute bar. So just by putting a buy stop 1 tick above highs and a sell stop 1 tick below lows, that gives us the opportunity to jump into the trade very early in the day and essentially get in with the momentum. And so yesterday, the market broke down and kind of traded through really quickly. In a minute, it really sold off. And then it's just a matter of trailing your stop, not putting a target out there, but just trailing your stop, 1 tick above each candle's high on the move down. When you get into situations where you have inside bars, then I just leave my stop alone here above the bigger body candle high, the candle that made the low. Just leave my stop up here and then let it do its thing, and then continue as after we break down, just move the stop again until you get stopped out down here, and then we actually have a change in trend. And I talk about in the video too how then you can look for bounces and look for potential reversals, especially about an hour into the morning. So just by bracketing the first 5-minute bar, it takes you an hour into the day and a pretty solid trade with just one trade. A good rule of thumb is whatever market or whatever time frame that you're trading is where you want to trail your stop. So if you enter on a 5-minute, then you want to trail your stop on a 5-minute. If I enter here on the 512, well, then I want to use the 512 to manage my trade. And 90% of the time, that's how it'll go. If I'm entering on a smaller time frame, like a 512, and it happens to be a bigger level, like it's visible on a 15-minute chart, I might use the 15-minute target instead of the 512 target if they're lining up. But for the most part, if you're trading on a 512, if you enter on the 512, trail on the 512. If I enter on the 5-minute, I'll trail on the 5-minute. If you're entering on a daily chart, a swing trade, then I'll trail on the daily chart. That helps keep things a little bit simpler as well. So now trading at this 24.75s in a relatively low tick on the day, but it's not a very low tick. We could easily go lower. But you can see on the 5-minute, we've got a pretty strong uptrend line. Again, that could easily be broken here, taken out. But it's a pretty clear line here. So if we can't hold this, if we sell off, we should have a nice opportunity. I mean, we should really sell off and have an opportunity to take a short here and maybe get down to yesterday's lows, just because this trend line is so defined. You have people with stops underneath each of these swing lows. But for now, we wait. So 24.75, getting a little bit of a bounce here. Again, I'm just going to leave my stop at -6 until we can come up and break this high. So we need to trade it at 28s before I'll tighten my stop. And in this case, moving it up underneath the low, we traded 1 point of heat. So that would bring my stop up by 1 tick. It's not really going to make much of a difference. Being comfortable with your initial stop is also really important. If you're stressing out about a point or 6 ticks or a couple of points, $100, it's, you have to take a step back and say, am I stretching myself too thin? Is this really, should I be trading? And that can be a hard thing to come to terms with. But trading is not for, if you're in a dire, have to make money, have to pay the bills state, lots of debt, lots of stress, and it's just not a very good recipe for success. There's a good amount of stress that's helpful, but most of the time the stresses can become overpowering. There's few situations where the market will, or where stressful situations and getting to your wit's end and feeling like you have no other opportunities can force you to take leaps of faith and move forward in a positive way. But trading, I don't see it happen quite so often. So here's another kind of, we'll call it a quadruple top, if you will, getting just kind of inching up here towards the top, making a higher low. So see how even though we're within the first 30-minute range, I don't just discount it completely and say, well, I'm not even going to look at the markets until we break out. I'm looking at the trend that's developing within the first 30-minute range, and you can clearly see this upward slope on the bottom end and the topping touching on the top end. So, taking a stab at along here, we may not be the one that breaks out, or like I said earlier, we may break down below this. As soon as we break one of these swing lows, we could really get into some accelerating downside movement. But in the meantime, you just kind of ride out where you're at. In this case, it's the long, and if it materializes, great. If not, it's going to yield other opportunities, and so you can't spend too much time micromanaging your thoughts and your trade after it takes you out, because you might miss something else. Now that we formed this high here, and we pull back, if we come up and break this high, I would entertain moving my stop up underneath the next swing low. It's not a huge move, but it is a valid opportunity to tighten. So when you talk about, how do I get my stop to break even? Well, it's not just the market traded 2 ticks in my favor and I'm going to right away move my stop. It's letting the market determine by getting some momentum, maybe pulling back a little bit, and then confirming that momentum. So now if you take your stop up to a 24.50 and you're basically at break even, you have a reason to be there. If you moved it up to 24.50 earlier, just because you were a point in the black, well, then the market would have come down and stopped you out, taken you out, and then reversed and gone in the direction you had wanted it to go, and you'd be frustrated, kicking yourself, and not in a good headspace. So here we've touched the top of the first 30-minute range. Now it's very possible here that we've touched this once, and we've touched the 50 a second time, this 2450s. We could easily come down, touch the third time, and then break out. We could get stopped out before the market gets moving, but because it was an anticipatory trade, meaning we hadn't broken highs yet, you got to half expect that. But at this point, if we can get up by another tick or so, we should get a little bit of a move. But if we can't, then retesting again or breaking down. So that may be a reason to just, if you haven't, the stop difference is a point. So you kind of ask yourself, okay, if I leave my stop down here at 2350s, I'm risking a point. But if we retest 2450s and bounce again, I'm risking a point to make 4 points. Those are pretty good reward to risk odds. So then you say, okay, well, yeah, I'm just going to leave my stop at 2350s. Take the point loss if it does break through. But the market could also come down and retest the 50 and then stop me out if I put my stop too tight. So, and you're going to get in situations where the market moves above highs, but it doesn't make it to the negative 23 yet. And you're kind of in this limbo, and your stop is 3 points away from your entry, and you're nervous and you're sweating and you're thinking, I don't want to give up this 3 points. But if you go into the trade knowing, okay, I'm going to use the negative 23 as my first target, I'm comfortable with a 6-tick stop, and I'm going to, either one of those is going to get hit. I'm going to get stopped out, or I'm going to hit my target. That can be a calming place to be. So there we go. Broke above the 28s, right to the negative 23. So if you have 2 contracts, taking one off at 29s or 28.75s is where I had my target. Pretty solid move. If you have 2 contracts, now it's just a matter of trailing your stop. And because we've broken out, you can use this swing high up here, 26.25. We can draw from lows to highs and say, okay, the next 61.8, I might use that because it's so close. We'll call it 26. Stop at 26 is where I'm going to put it. So even though, coming back to that first 30-minute range, yes, we were in the first 30-minute range, but it doesn't mean you just discard it and set an alert and come back later. Watching the trend develop can give you some insight to which direction you might want to place trades. Now, we should get some support at 27.28s. If we don't, then it's very likely that we're going to, take out this upward trend line and make a move all the way down to lows. So now it's just kind of a waiting game. We're in a trade. We've taken a profit. We've basically locked in profitability on the trade. Even if the second half gets taken out, you're still well in the black. And if the market does get a lift here and we start to run up, then great. We're already in. We don't have to get in again, take on new risk, and have that 6 ticks risk on the table. So that's why scaling out is so powerful, because the market's not always going to make a full retracement. Sometimes it's strong and it doesn't make a full retracement. Here's a break below the inverted hammer of the 5-minute, and a break taking us out of the long. So we may get our trend line break, or we may just come down a little more and shake some folks out and try again to move higher. But even if all the market does is get to the negative 23, That's still, by using the negative 23, it's good reward to risk. 29s, 24.5, 3.5 points by risking 1.5 points. I definitely take that trade every time. $7.18. I did get a high ticket highs, not the highest, but close to it. With this trend line support here, you don't always get so lucky to have such a strong, defined trend line. And if it breaks, it should break pretty hard. So drawing from highs to lows, a 27.50 would be the top of the first 30-minute range, definitely a valid short opportunity. And then when you get in this rhythm of, you take a short earlier in the day, take a long, you take a couple of trades, you get, 3 points here and maybe a little bit extra on the second half of the position if you've got 2 or more contracts. You pick up 2 points, you pick up 4 points. Now you got a little bit of wiggle room to work with. So yeah, we're not hitting anything out of the park, but some days you have 5, 6, 7 trades, and even if they were all just for 2 points, you end up with a nice day. Look at the pattern here and the move up. 2 candles up, 2 down. 1 up, 2 down. 2 up, 1 down. 2 up, 1 down. So not more than 2 candles in one direction. And holding the previous swing low. So the trend here is clearly very strongly up in terms of the structure itself. So if we break 23.75s, that would be the prior swing low, then I would expect a very strong move, at least initially down, because you have people starting to get their stops taken out. That accelerates the market down, and people start to panic, and that accelerates it more, and you know how it goes. Didn't notice much here at the top of the hour. It would make sense that consumer confidence would be a little bit more shaky, especially as you get into the meat of discussions, meat of the work. When there's rumors, when there's things are in idea stages, you're really excited. You wake up in the middle of the night and you have a great idea and you're all fired up. When you actually get in it, start working through it, it's not always as rosy of a picture. So as you get into the meat of some of these topics that sound really great at the beginning of a campaign or beginning of a changing of the guard, if you will, different leadership coming on board, you get excited. You get a new coach, you get excited. And then you get in there and you start doing the work and you realize, oh, this is hard and this is challenging. Your confidence may dwindle a little bit in the middle. But then if you still focus on the goal, just keep pushing forward, you can get through it and come out the other side ahead. The difference here in Home Depot, we made this nice strong run up and we have pulled back, but we haven't formed a solid higher low. So the market, we could pull back to 190 and then bounce, and I would still ride the trade out because we formed the high, but have not solidified a swing low. Whereas like in the case of Apple here, we've got this lower low, lower high, lower low, lower high. The trend has already shifted. Now when you get into many multiples of contracts or multiple shares, again, you can always scale out at different points. Taking a little bit of profit on a portion is healthy. NASDAQ already showing a little bit more weakness, trading at its short. I didn't look at that quite soon enough. But the NASDAQ trading at its lower high, now back at the halfway back of the day. You can see that same upward slope on the YM. And the ES starting to break that upward trend line. Could get into some wild markets again here. The 5 minutes is a good chart to look at the candle patterns. It's enough information that there's larger time frame traders placing trades off them, but it's not so small that it's just noise. So anytime you break like the low of an inverted hammer, or break above the high of the low bar, that's pretty significant. And sometimes that break in itself, just shorting below the low of the high bar, that's a really great way to just get in and ride it. So you can take a stab at 24.75s, or we can go full halfway back. We could really start accelerating here. We're at the top of the first 30-minute range, so a quick move down to the bottom to 18s and then all the way through to yesterday's value low is very likely. opposing tails in the first 30-minute bars here. We are the second 30-minute bar is the high. Because clearly the tail made the high here. So a trading of 2250s could be significant. I'm going to get rid of the short for now. I know it's up here, 48s. This makes my screen a little bit too cluttered. So a 24.75 would be a little bit aggressive. And then a 26.25 would be more conservative. But we got a low tick down here. We are trading, the potential reward for catching a short here at 24.75s could be really big. Not just the negative 23% target, but if we really roll over and start to move fast. So, and that was the same case for the long. Why I took the long before we broke out of the first 30-minute range, because of the potential. We're underneath this upward trend line here, and we could really get moving fast. And there may not be another opportunity right away. So it looks like the 24.75 is holding. Here's that little double bottom again that we saw earlier. There's definitely bulls jumping in. But you need those bulls to jump in to be placing stops so that when the market does start spiraling down, there's a big dip. Let me look at the full. Yeah, we're trading at the halfway back long for the day, but we did break at 61.8. So there's the 24.75 that trades. The full short again is a 26.25. Kind of the backside of that trend line. You can split the difference in situations like this where you have two. You can kind of come up and maybe say, well, take it around the 61.8 and risk missing the entry, but also kind of split the difference in case it does go in a little bit. But again, I try not to get too fancy with it. Just taking stuff at the 50 and entering a trade at the 50 in and of itself is a lower risk entry point. So that's enough confidence for me to know that, okay, I've identified the trend. I'm not chasing it. I'm letting it pull back. Again, that low that we're touching on is the bottom of the second 30 minutes. So if we can get down to 2250s, there it is. And is there buying? Is there selling? A pause, not acceleration. That's interesting. So there's definitely buyers holding the market up here. may take a little bit more. One of these swing lows down here, definitely a break of lows in the morning. I guess that's only 18, about 5 points we would need to move for the market to break the lows in the morning. So we shall see. 22s is the target on this short here, for the first target at the negative 23. So again, that's about 3 points. I would say this would be more of a typical day. You got 4, 5, 6 trades by the end of the morning. Sometimes only 2, 3 trades, but nothing huge. Not like yesterday where you get a 20-point runner right off the open. But those gap and go days, or gap and fill days like that, maybe get one a month that is that big, or every other month. But you just always want to be kind of on the lookout, if you will. So there's our 22s. So we've got our 3 points locked in. And again, just like before, we can draw up the next short, kind of saying, well, if I wasn't in a trade, where would I want to get in and where would I be wrong? And then you can start trailing the 61.8. If the market were to dive off a cliff here, I would start trailing each candle's high as a way to kind of capitalize on a quick 3, 4, 5 points if the market starts ripping down. You can just trail each candle's high, but at this point, we're just at the negative 23, so it hasn't really accelerated that much. But if you want to bring your stop down to a 24 or 23.75, it would be. You could do that. Otherwise, we haven't made a pullback and then a break of lows to form a lower high. But I like what I'm seeing here on the little bit bigger time frame, being on the underside of the trend line. I mean, look at where the trend line starts, all the way down here at 2,700. So 20 points away. If you're not in a trade, 22.50s is a valid short. It's the next short. Breadth and advanced decline line still pretty flat. Still not getting that panic drop off here. And we may not get it, but just going to trade what I see. It's 22.50s trade. Again, we need to break lows, and then you can tighten your stop to 23s. And then see if you're already in the trade, having your stop at 23.75s, kind of keeps you up above that 61.8. Again, sometimes what we've been seeing today, this double bottom and then retesting. Just going to leave my stop at 23.50s. I'm sorry, 75s. Because we've been, see here, we've double bottomed, bounced, and then retested the 50. If I tightened it exactly to the high or exactly to the 50, it might get taken out. And I'm, if you put on the trade at 22.50s and you want to bring your stop down, you kind of have to ask yourself, am I willing to risk 6 ticks to make 6 points? The trade has only gone in 2 points in your favor. By bringing your stop to break even, it doesn't really get you any further, doesn't make the trade profitable by just bringing the stop to break even. So again, if you can become comfortable with, okay, I'm placing a trade and I've already I've already been stopped out before you even place the trade. And then kind of step 2 is, okay, I'm either going to get stopped out or I'm going to hit my negative 23% target. I'm not going to do anything in between. But that's where the value in trailing, if you just went all in, all out, every single trade, 50% to negative 23, take it off. And then get into the next 50%, ride it to the negative 23, and take it off. Well, there's plenty of situations where we don't make a full pullback to the 50. So you don't get an entry. Or there's plenty of situations where the market starts down, like here, trades at the negative 23, and then moves up to the next 50%, and maybe we just rip higher from here. And in which case, there's not much to capitalize on this next setup. It's been quite a few years since I've seen 7, 8, 9, 10 setups in a row, just trade after trade after trade on these 512s. So, you're getting a lot more 3, 4 trades in a row, and then the momentum changes. And I think that's just a byproduct of all of the computerized trading and things like that, strategies that are trying to get the market to just break a swing low or break a swing high, flip the computer, flip the trend short term to shake people out. Yeah, I never increase my stop size. So there'd be some situations where if let's say I'm up at highs and I'm shorting up at highs, I might just put my stop a tick or two above highs, and it might not be 6 ticks, it might be 4 ticks. But you never want to increase your stop size. And even with decreasing it, what if it's 6 versus 4? If you get stopped out at 4 ticks and had your stop at 6 ticks, you wouldn't be stopped out. I mean, you're just going to be kicking yourself. Another situation of a retest. That's where looking back to, like in the first 15 minutes, I was saying, well, I'm not placing trades here, but I'm just using it as a way to get a read on the markets. How is it reacting? Are we trading at 50%? Okay, yes, we are. Are we trading in the middle of the range? No, we're not. Are we pretty clean? Nice strings of red and green moving in one direction, then another direction? Yes, we are. Over here, okay, are we trading at the 50 and then ripping down? Not really. We're kind of getting this double bottom and then a retest. So that tells me being a little conservative with my stop is going to be helpful. So same thing here. Entering at the 50, or entering up here on the 24.75s, letting the market come down, not being overly aggressive with my stop, just keeping it above the 61.8. Now that we've touched the next negative 23, so if you didn't take the first short and then you just took the second one, you've got your 1975s, so a 2250s down to a 1975s. Take your first contract off there. Stop now can be one tick above this swing high at a 23.25. And there's our break of lows. So this could really get going. We can draw up the next short. I'd consider moving my stop to a 21s. Let me get that right anchor. And 21.25. Notice we broke lows and did not accelerate right away. So that there's these buyers are definitely, that's a big one, breaking lows here of the morning, and the pace at which we do that tells you a lot. So there's not as many longs that have stops as I would have thought, just because we've come down, we broke lows, and then we sort of paused. We didn't rip right through. So in that case, I'm going to go ahead and put my stop at a 21.25s because we broke lows. We're at lows now, so we could, in a range-bound day, if we broke highs, broke out of the first 30-minute range, and what do? We go right to the bottom. So now breaking lows by just a tick, trading at the bottom of the first 30-minute range, and coming back into it, there's a good chance that we come up to 28s. Or, the 50% could hold, and if it does, then that 21.25 stop is going to keep us in the trade. But if not, you get out and look to go from the bottom to the top. So even though we're in an inside day, the first 30-minute range, it's a great example of a market that is not necessarily slow. So there's a low to high, 15, we'll call it a 16, 27.16. And that makes sense. 27.16 is the point of control. So I would expect there to be some decent support. It also lines up with kind of it makes sense. It's the midpoint of yesterday, but the top of these bodies as well. So as you start to put together the pieces, it can give you small pieces can really give you a lot of insight into the market. So there's our 21.25. So another couple points in the bucket. No low tick at lows, no high tick at highs, just good retracements and decent moves. All there is to it. Now the swing high is all the way up here at 23. So the market has a little bit of a ways to go. Or we could roll over and double bottom and break this swing high. But we shall see. So Mike, now the 2075 is a valid long. The one thing about this one that's a little bit different, 2075 down to lows is about 3 points. And we've got this 50% below us, that's 16. I guess what I see happening is we either don't make the 50% full pullback, we just go up from here because we have this big V reversal, or we come all the way back down and retest. And I can't give you a very concrete reason other than it's just something I've seen happen quite a bit with these V reversals. So if we look over here, look at how in the morning when we opened, we kind of stair-stepped our way down. And then that forced us to stair-step and make a nice little pullback. 2720s was only, a point and a half from lows. So it's pretty close to lows. You're stair-stepping down. You're going to you have some highs to break on the way up. Well, when we get into a situation like this, where it's straight down and then we go straight back up, the likelihood that the market makes a clean reversal at the 50, and we also have, this 50, a 2075 is further away from lows. It's a little bit riskier, and I don't see them work quite as cleanly. And I could see the market coming down a little bit lower. We were at a 17 and a quarter. To go another point and a half lower, kind of fake some people out here, make them think that, oh, here it is, here's the breakdown. But really, it's just a move 1 point lower to the long, and then we rip to highs. So I'm gonna pass on this long, the long answer of your question here. We are close to the halfway back short of the day, which just means we're in the middle of the range. Yep, precisely, Jay. And so you can think of any 50% as a better place to enter than just getting long at highs or shorting at lows, or just, kind of throwing an order out there. But sometimes, there's 50% that in the context, in and of themselves, the 50% is a great place to enter a trade. But in the context of where is this 50% in the trend? Is it the first one? Is it the fifth one? And what was happening just before the 50% kind of started? And as we come over here, what has happened? Well, we're kind of, how close are we? We're pretty much, if you were shorting this 50, which I'm not, the order would be 2350s, and you wouldn't have gotten filled yet because we're just trading at it. But if we rolled away from it here, we may have enough momentum to come down and break the long. And so for that reason, we've got these opposing tails as well on the 30-minute chart. And so with a balanced breadth and advanced decline line, pretty horizontal, nicey tick, opposing tails, V reversal, trading in the first 30-minute range, trading right smack dab in the middle of yesterday's range. Those are all the factors that come into play and then kind of enter my head as intuition. And, could we stop right here at 2075s and make a beautiful bounce? Sure. But to me, the reward to risk on that setup just isn't there at this time of the morning. If we break lows or break highs, now I'd be a little bit more interested in jumping in. But there's a point at which the reward to risk comes into play, and you got to kind of weigh the opportunity at hand. And just because you've got 10 points in the bank doesn't mean that you take extra risks. Sure, it's great to have, a few winning trades so that you kind of get the sense that you're playing with profits. And the more you can bank in your trading account, and especially as you start withdrawing on the other end, and you're totally playing with all the money in your account. Once you've withdrawn your initial investment, it definitely changes the dynamic of the risks that you're taking. And if you can get on a regular schedule of taking an amount that you can consistently draw from your account, that you can still cover your drawdowns. You don't want to, if you got $10,000 in your account, you don't want to take out $9,000. And if you have a $1,000 drawdown, all of a sudden you're empty. But if you got $10,000 in your account and your max drawdown, your max weekly loss is say $500, taking out $250 or $500 a week can be a motivating thing. Yep, right on, Jay. The market is kind of in this indecisive point, whereas on the move down, we stair-stepped nice, and it was we were headed right towards lows. Prior to that, on the move up, we were sort of stair-stepping our way up, making that nice ascending triangle, but here, sort of in limbo. So as we kind of wrap things up for at least the morning session, I'm more interested in the market moving below lows or below the first 30-minute range or above it. This time of the day, as you head into the Eastern time zone, kind of early lunch, 11 o'clock time frame, there's a lot of times you get a slowing and not as much participation. So we'll leave it at that for today. Pretty good day in terms of the context. Like I was saying, an inside day, inside the first 30 minutes, and we had 3 solid trades that sometimes just hitting singles and doubles can add up nicely. So you never want to discount a day just because of how it starts or where we're at, because the market can always turn into something interesting. If we break, one last little note, if we break 27.25s, we could get a little bit of a lift. That would be up here, just because it's the high of the low bar here today, and might be enough to make us go back up to these highs. So 27.28s, 27.18s, that's the top and bottom of the first 30-minute range. That's where I'm going to put my focus for the rest of the morning. So I hope everyone has a great day, and as always, thanks for tuning in. We'll talk to you soon.